Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories in companies' latest financial reports. Today we're diving deep into Citizens Financial Group's annual filing for 2025. Get ready because this report is packed with big numbers strategies under scrutiny and some eye-opening risk disclosures. So what is the big picture for Citizens Financial Group Inc., or CFG as they're known on the New York Stock Exchange? Well, in 2025, they reported a net income of $1.8 billion, which is a pretty solid jump up from the previous year. That translates to earnings per S-share of $3.86, a nice increase for shareholders. Digging into their income statements for 2025 shows total revenues hitting $8.2 billion. Non-interest income jumped by $2.18 billion, making up a good chunk of their earnings. Specifically, wealth fees and capital markets fees saw significant growth, indicating a stronger push into advisory and investment services. Citizens Financial Group is a big player in the financial world, and they've recently filed their annual report on Form 10-K for the year ended the 31st of December 2025. This filing is super important because it gives us a detailed look at their financial health, their business strategies, and all the juicy risks they're facing. They've confirmed they've filed all their required reports for the last 90 days and are a large accelerated filer, meaning they're a big fish in the financial pond. Let's look at how their stock has performed. If you had invested $100 on the 31st of December 2020, you would have had $202 worth of stock by the 31st of December 2025. That is a pretty good return, outperforming the broader S&P 500 index and the KBW Nasdaq Bank Index. Their peer regional banks, however, saw a return to $163, which shows CFG has been a strong performer comparatively. Looking at their balance sheet as of the 31st of December 2025, total assets reached a massive $226.3 billion. On the flip side, their total liabilities were around $200 billion, leaving them with stockholders' equity of about $26.3 billion. They've got more assets than liabilities, which is generally a good sign. Deposits from customers are crucial for banks, and Citizens Financial Group saw a solid increase in deposits, reaching $183.3 billion by the end of 2025, compared to $174.7 billion in 2024. This growth was mainly fueled by their private bank and commercial businesses. However, they did reduce their reliance on higher cost brokered deposits, which hints at a strategy to manage funding costs more efficiently. Scroll total commercial $73,812. Side foreign breaking down their loan portfolio shows growth in commercial loans to $73.8 billion in 2025, a significant increase from $69.7 billion in 2024. This indicates a focus on expanding their commercial lending activities. However, their retail loans saw a slight dip, primarily due to the sale of education loans and the planned runoff of their auto loan portfolio. Now let's talk about the loans that are causing some worry. Non-accrual loans, which are loans where borrowers have stopped making payments, are at 1.05% of their total loan portfolio. In 2025, a slight improvement from 1.20% in 2024. While this is a relatively low percentage, it is always something to keep an eye on, especially during uncertain economic times. Their allowance for credit losses for these non-accrual loans is actually higher than the non-accrual amount itself, which signals they are being cautious and have set aside more money than strictly needed for potentially bad loans. The total allowance for credit losses, which is the money banks set aside for potential loan defaults, decreased slightly to $2.18 billion in 2025 compared to $2.25 billion in 2024. This decrease is attributed to an improving loan mix and reduced exposure to commercial real estate, among other factors. Let's talk about how interest rate changes could impact their profits. Their net interest income actually benefits from rising interest rates, with a 1.8% increase expected for a 200 basis point jump in rates. This means they're pretty well positioned if rates continue to climb, but a significant rate drop could also hurt their earnings. Citizens Financial Group isn't just playing with loans and deposits, they're also heavily involved in derivatives to manage risk. Their derivative assets total $1.5 billion, while their liabilities are $1.2 billion. They use these instruments to hedge against interest rate fluctuations and foreign exchange risks. Looking at their income statement, non-interest income is a big story. It jumped to $2.39 billion in 2025, up significantly from $2.17 billion in 2024. This growth is largely driven by their wealth management and capital markets divisions, showing a successful push into higher fee-generating businesses. But all this growth comes at a cost. Non-interest expenses also increased, hitting $5.3 billion. A big chunk of this increase is in salaries and benefits, reflecting investments in their private banking and wealth management teams. This is a classic trade-off. Growth often means higher operational costs. Now let's talk about the risks. They're clear about the fact that they might not be able to execute their business strategy perfectly. They also highlight the possibility of regulatory headwinds and the impact of inflation on their business. These are significant risks that could affect their bottom line. The company is very upfront about the risks of inflation. They acknowledge it could increase their funding costs and expenses and negatively impact consumer demand and borrowers' ability to repay loans. This is a pretty standard risk for financial institutions in the current economic climate. Liquidity is a critical concern for any bank. Citizens Financial Group's report spells out their reliance on customer deposits and other sources, like securitizing loans and accessing capital markets. They also acknowledge that negative economic events or a loss of confidence could make it harder and more expensive to get the funds they need. Credit ratings are super important for banks. A downgrade could make it more expensive for them to borrow money, increase their liquidity risks, and even impact their ability to do business with certain clients. They state that this could materially affect their business financial condition and operations, which is a pretty strong warning. And speaking of risks, the report highlights their heavy reliance on third-party vendors for its functions. A failure or security breach at one of these vendors could have serious consequences for Citizens Financial Group, from operational disruptions to data security issues. This is a major vulnerability in today's digital world. Looking back at the numbers for 2025, the bank reported a net income of $1.8 billion, a clear improvement from $1.5 billion in 2024. Their net interest income, which is the core profit from lending, also grew. Meanwhile, their total revenue reached $8.2 billion, up from $7.8 billion in 2024. This revenue growth is driven by strong performance in wealth management and capital markets. The company seems to be executing its strategy of expanding into higher margin fee-based businesses. The fact that their allowance for credit losses decreased while their loans grew is a positive signal, usually meaning they believe their loan portfolio is getting stronger or less risky. Now for the boring but important stuff, management's report on internal controls. They say their controls are effective, but as always there is that standard disclaimer that no internal control system is perfect. The independent auditors Deloitte IMP Touch LLP agree with management's assessment for both financial statements and internal controls. The auditors flagged the allowance for credit losses as a critical audit matter. This is not really surprising given the significant judgment involved in estimating potential loan losses. The report details a lot of complex assumptions about economic forecasts and qualitative adjustments. Looking at the exhibits, as is typical for a company this size, there is a bunch of legal documents like their restated certificate of incorporation and bylaws. Then there are many complex debt and equity agreements that outline their borrowing structure, which is quite extensive. So what is the verdict on CFG after looking at this filing? They're clearly making strides in expanding their fee income businesses like wealth management and capital markets, which is a smart move away from more traditional interest rate dependent banking. Their loan book is growing, especially in commercial areas, and they seem confident in their allowance for credit losses. However, they aren't immune to the risks. We're all facing inflation, geopolitical instability, and cybersecurity. Threats are all major concerns that they themselves highlight. The company is performing well against its peers and has a strong capital position, but the increasing reliance on third party, it also presents a significant ongoing risk that needs constant attention. Overall, Citizens Financial Group is navigating a complex financial landscape with a mix of proactive strategies and a realistic acknowledgement of the risks involved. That is our deep dive into Citizens Financial Group's latest annual report. What are your thoughts on their performance and their risk mitigation strategies? Drop your analysis in the comments below. If you found this decoder useful, give us a thumbs up. Subscribe to Corporate Decoder for more insights like this and hit that notification bell so you don't miss our next video. Also join our Discord community linked in the description to continue the conversation. Thanks for watching, and until next time, stay curious.